Between October 2024 and January 2026, $847 billion in corporate assets quietly left American soil. Apple transferred $191 billion through Irish subsidiaries. Google restructured $89 billion across Singapore and Bermuda. Tesla moved $34 billion to Netherlands, holding companies in transactions that barely made headlines. This isn't tax planning. This is stage 3 capital flight behavior. The exact same pattern that preceded the collapse of Amsterdam in 1772, London in 1931, and every reserve currency empire in recorded history. A pattern so mathematically predictable that once you see the 4-stage sequence, you'll realize what's happening right now isn't random corporate strategy. It's systematic wealth evacuation. And the timeline from stage 3 to stage 4 averages 18 to 36 months across every historical example. We're 14 months in. Here's what nobody's telling you. When corporations move assets offshore at this scale, they're not optimizing taxes. They're hedging against sovereign risk. They see something in the balance sheets, something in the debt trajectories, something in the monetary policy that tells them the current system has an expiration date. Stay with me, because in the next 18 minutes, you'll see the exact 4-stage pattern, how it played out across 3 empire collapses, where we are in the cycle right now, and what the final stage looks like when it arrives. Let me show you something that once you see it, you can't unsee it. Capital doesn't flee randomly, it follows a pattern. Stage 1, the empire establishes reserve currency dominance. Money flows in because holding that currency is the safest bet on earth. Stage 2, the empire starts spending beyond its means. Deficits grow, but nobody cares because the currency is still trusted. Stage 3, the smart money, major banking families, corporations, institutional wealth, starts quietly repositioning assets. Not panic, deliberate, systematic diversification. Stage 4, the currency loses reserve status, capital flight becomes a stampede, and wealth transfers to the next ascending power. This pattern has repeated with mechanical precision across 500 years. And right now, in January 2026, every indicator says we're deep in stage 3, accelerating toward stage 4. Here's how you know you're in stage 3. Corporate offshore asset movements exceed $500 billion annually. Check. U.S. Treasury holdings by foreign central banks decline for 18 plus consecutive months. Check. Major corporations restructure international holdings to limit dollar exposure. Check. Gold purchases by central banks hit multi-decade highs. Check. The pattern doesn't lie. Amsterdam, 1600s. The Dutch guilder was the world's reserve currency. The Dutch East India Company was the Apple of its era, largest corporation on earth, $828 trillion in modern value. Amsterdam controlled global trade routes. If you wanted to trade spices, textiles, precious metals, you used guilders. The currency was unassailable until it wasn't. Stage 1 lasted from 1602 to 1650. Guilders poured into Amsterdam. Wealth accumulated. The Dutch became the banking center of Europe. Everyone held guilders because guilders were stability itself. Stage 2 started around 1650. The Dutch fought 4 wars with England between 1652 and 1784. Wars are expensive. The Dutch East India Company started borrowing. Government debt grew from 30 million guilders in 1650 to 128 million guilders by 1713. But the guilder was still reserve currency, so debt didn't matter. They could always borrow more. Stage 3 began around 1750. The smart money started moving. Major banking families, the Hopes, the Cliffords, began diversifying into London. Corporate entities restructured holdings. British East India Company stock became attractive. The transitions were quiet. No announcements, no panic. Just systematic repositioning. The exact same behavior Apple, Google, and Tesla are exhibiting right now. By 1772, the inflection point hit. A banking crisis in Amsterdam triggered by the collapse of Clifford & Sons exposed how leveraged the entire system had become. Within weeks, 40 banks failed. The guilder lost 30% of its value. Capital fled to London. Stage 4 was complete. The British pound became the new reserve currency. Dutch wealth evaporated. British wealth exploded. The wealth didn't disappear, it transferred. And the families who saw stage 3 and repositioned accordingly captured generational fortunes. Same pattern, different century. London, 1800s. The British pound was global reserve currency for 120 years. At its peak in 1913, Britain controlled 25% of Earth's landmass. The Royal Navy ruled the seas, and the pound sterling was used for 60% of global trade transactions. You couldn't do international business without pounds. The currency was mathematical certainty. Stage 1 ran from 1815 to 1880. After Napoleon's defeat, pounds flooded into London. The Industrial Revolution concentrated wealth. Britain became the global banking center. If you had money, you held pounds. Stage 2 started around 1880. Colonial expenses grew. The Boer Wars cost $200 million. World War I cost $35 billion, just 120% of Britain's GDP. Government debt exploded from 30% of GDP in 1914 to 180% by 1920. But the pound was still reserve currency. Nobody worried. Stage 3 behavior emerged in the 1920s. Major banking houses, J.P. Morgan, Rothschild, began quietly shifting to dollar-denominated assets. Corporations restructured international operations. In 1925, British gold reserves stood at $150 million. By 1931, they'd dropped to $130 million, despite massive empire wealth. The gold was leaving. Not panic, systematic repositioning. In September 1931, Britain abandoned the gold standard. The pound crashed 25% overnight. Within 18 months, 25 countries followed Britain off gold. Capital stampeded to America. The dollar became the new reserve currency. British wealth evaporated. American wealth exploded. The families who saw stage 3 and moved to dollars before 1931 multiplied their wealth by 3x to 5px, while their neighbors lost everything. The pattern is absolute. Now watch it happen a third time with perfect precision. The American dollar became reserve currency in 1944 at Bretton Woods. 44 nations agreed to peg their currencies to the dollar. The dollar was backed by gold at $35 per ounce. America held 70% of the world's monetary gold. Holding dollars was holding gold. The system was unbreakable. Stage 1 ran from 1944 to 1965. Dollars flooded into U.S. treasuries. Post-war boom, manufacturing dominance. Global trade ran on dollars. The currency was absolute safety. Stage 2 started with the Vietnam War. The war cost $168 billion over 20 years. Social programs expanded, Medicare, Medicaid, Social Security. Government spending exceeded revenue every year from 1970 onward. But the dollar was reserve currency. The world needed dollars. Deficits didn't matter. Until France noticed. In 1965, French Finance Minister Valéry Giscard d'Estaing saw the pattern. He saw U.S. gold reserves declining from 20,000 tons in 1950 to 9,000 tons by 1971. He saw dollars being printed beyond gold backing. Stage 3 behavior. France started converting dollar reserves to gold. $191 million in gold left Fort Knox to Paris between 1965 and 1968. Other nations followed. Germany, Switzerland, Netherlands, all converting dollars to gold, all repositioning quietly. On August 15, 1971, Richard Nixon closed the gold window, ended dollar convertibility to gold. The dollar lost 50% of its value against gold over the next decade. But here's the critical difference. The dollar remained reserve currency because of the petrodollar system established in 1974. Oil had to be purchased in dollars. This gave the dollar a second life, an extended stage 2 that's lasted 50 years beyond normal pattern timeframes. But that extension is ending, and stage 3 behavior is now unmistakable. Let me show you exactly what's happening right now, today, in January 2026. The pattern is playing out in real time, and the acceleration is terrifying. U.S. national debt, $38.5 trillion, that's 123% of GDP. Deficit spending, $2.1 trillion in fiscal year 2025. Interest payments on debt, $1.7 trillion annually as of December 2025. That's more than the defense budget. For the first time in American history, the government is borrowing money just to pay interest on money it already borrowed. Classic stage 3 mathematics. Now watch the corporate behavior. According to Bloomberg terminal data from December 2025, S&P 500 companies hold $3.7 trillion in offshore subsidiaries. That number was $2.1 trillion in 2019, a 76% increase in 6 years. This isn't gradual growth. This is acceleration. Apple is Irish subsidiaries held $191 billion as of Q4 2025. That's 68% of Apple's total cash reserves. Google restructured Alphabet's international holdings in 2024, moving $89 billion in intellectual property assets to Singapore entities. Tesla established Netherlands holding companies in March 2025 and transferred $34 billion in battery technology assets and European manufacturing rights. These aren't tax moves. Ireland's corporate tax rate changed in 2023, making it less advantageous. The total $847 billion in 14 months. This is stage 3 capital flight. The same behavior Dutch banking families exhibited in 1750. The same behavior British institutions showed in 1925. Systematic, quiet, deliberate repositioning. But corporations aren't alone. Central banks are repositioning too. China reduced U.S. Treasury holdings from $1.1 trillion in 2021 to $778 billion in December 2025. Japan dropped from $1.3 trillion to $1.09 trillion. Saudi Arabia cut holdings by $38 billion in 2025 alone. They're selling treasuries and buying gold. According to World Gold Council data from January 2026, central banks purchased 1,045 tons of gold in 2025, the highest annual purchase since 1967. China added 225 tons. Russia added 156 tons. India, Turkey, Poland, Singapore, all buying gold at rates not seen in 60 years. This is classic stage 3 behavior. When central banks lose confidence in the reserve currency, they don't announce it. They don't hold press conferences. They just quietly shift to hard assets. The pattern is screaming. And then there's the wealth migration. According to Henley and Partners' 2025 Private Wealth Migration Report, 142,000 millionaires relocated internationally in 2025. That's double the 2019 number. The United States saw a net outflow of 8,900 millionaires. First net outflow since 1945. UK lost 10,800 millionaires. Total liquid wealth leaving, 426 billion. Where's it going? UAE saw a net inflow of 6,700 millionaires. Singapore gained 3,200. Switzerland added 2,400. These aren't retirements to sunny beaches. These are strategic relocations to jurisdictions with currency stability, asset protection, and diversified reserve holdings. The smart money is repositioning. They see what's coming. Now I know what you're thinking. But America is different. We have the strongest military in history. We're the global superpower. The dollar is used in 88% of international transactions. This time is different. It's exactly what the Dutch thought. They had the largest navy, controlled global trade routes. The guilder was used in 70% of European transactions. Didn't matter. The mathematics overtook the military. That's exactly what the British thought. They controlled 25% of Earth, had the Royal Navy. The pound was reserve currency for 120 years. Didn't matter. When debt exceeds 120% of GDP and deficits run 6 to 8% of GDP annually, no amount of military power changes the mathematics. The pattern doesn't care about military strength. It doesn't care about historical dominance. It cares about 3 numbers: debt to GDP ratio, deficit spending as percentage of GDP, and foreign reserve holdings. When debt to GDP crosses 120%, deficit spending stays above 5%, and foreign holders reduce reserves for 18 plus consecutive months, stage 4 is inevitable. The timeline averages 18 to 36 months from acceleration point. The U.S. crossed 120% debt to GDP in March 2024. Deficit spending has been above 6% since 2020. Foreign treasury holdings have declined for 22 consecutive months as of January 2026. We're 22 months into the pattern. Here's another objection. But the dollar is backed by the full faith and credit of the United States government. So was the guilder, backed by the full faith of the Dutch Republic, the most powerful nation in Europe in 1750. Collapsed in 22 years. So was the pound. Backed by the British Empire, the largest empire in human history, lost reserve status in 16 years after the acceleration point. Full faith and credit is just words. Mathematics is absolute. When interest payments exceed 25% of tax revenue, the system is mathematically unsustainable. U.S. tax revenue in fiscal year 2025, $447 trillion. Interest payments, $1.07 trillion. That's 24% of revenue going to interest. We're already there. And here's what nobody's telling you. This percentage only goes one direction. As debt increases, interest payments increase. As interest payments increase, deficits increase. As deficits increase, more borrowing is required. It's a mathematical spiral with one endpoint: currency crisis. The pattern doesn't need your belief. It's unfolding whether you accept it or not. So what does stage 4 look like? Let me show you exactly what the historical pattern says happens next. Stage 4 starts with a trigger event. In Amsterdam, it was the Clifford & Sons bank collapse. In London, it was Britain abandoning gold standard. The trigger is usually sudden, but it's never the cause. It's the revelation that exposes what's already broken. For the dollar, the trigger will likely be a treasury auction failure. That's when the U.S. government offers bonds and can't find enough buyers at acceptable interest rates. It hasn't happened yet. But the warning signs are visible. In October 2025, a 30-year treasury auction saw the lowest demand-to-cover ratio since 2009. Foreign buyers took only 58% of the auction compared to 72% historical average. When an auction fails, interest rates spike. When rates spike, interest payments explode. When payments explode, deficits balloon. When deficits balloon, more auctions are required. The spiral accelerates. Historical timeline from first failed auction to full crisis, 8 to 14 months. In stage 4, capital flight accelerates exponentially. What was quiet repositioning becomes obvious exodus. Foreign central banks dump treasuries. Corporations repatriate $0 and keep everything offshore. Wealthy individuals accelerate relocations. According to Henley's projections, if stage 4 hits, millionaire migration could reach 500,000 plus annually, $1.5 trillion in wealth leaving. Currency value collapses. The Dutch guilder lost 43% in the first year after crisis. The British pound lost 47% against gold between 1931 and 1934. The average reserve currency collapsed 40 to 60% of purchasing power in the first 18 months. And here's the critical part. The wealth doesn't disappear. It transfers. When the guilder collapsed, British pound holders gained 78% purchasing power relative to Dutch assets. When the pound collapsed, dollar holders gained 112% relative to British assets. The next reserve currency, likely the Chinese yuan or a basket of currencies including yuan, euro, and gold, will see massive purchasing power gains as the dollar declines. The question isn't whether this happens. History says it's inevitable. The question is timing. Based on the pattern, here's the timeline. We're currently in late stage 3. Corporate repositioning, confirmed. Central bank diversification, confirmed. Wealth migration, confirmed. All 3 indicators are accelerating, not slowing. Stage 4, trigger event. 70% probability within 18 months. That puts the window between July 2026 and July 2027. Currency crisis, 12 to 18 months after trigger. That's mid-2027 to early 2029. Full reserve currency transition, 3 to 5 years after crisis begins. That's 2030 to 2034. These aren't predictions. These are historical averages applied to current acceleration rates. Watch for these specific indicators that confirm the transition to stage 4. First, treasury auction failure, where bid-to-cover ratio drops below 2.0 and foreign participation drops below 50%. Second, Federal Reserve forced to buy 40% plus of treasury issuance to prevent auction failure. Third, major corporation announces full repatriation halt, bringing zero offshore cash back to U.S. Fourth, G7 nation announces reduction of dollar reserves by 20% plus in single quarter. Fifth, gold price sustained above $3,500 per ounce for 90 plus days. Any one of these indicators is concerning. 3 or more is confirmation that stage 4 has begun. So what does this mean for you personally right now in January 2026? You have 2 choices. Choice 1, trust the system. Believe that 500 years of historical pattern will break. Believe that $38.5 trillion in debt at 123% of GDP is sustainable. Believe that corporations moving $847 billion offshore is just tax optimization. Believe that 22 consecutive months of foreign reserve reduction is coincidence. Keep 100% of assets in dollar-denominated holdings, and hope this time is different. Or choice 2, understand the pattern and position accordingly. Here's what positioning accordingly looks like, based on what worked in every previous reserve currency transition. Asset diversification outside dollar-denominated holdings. In the 1920s, British collapse, families who held 30-40% of wealth in dollar assets. Gold and international equities preserved purchasing power. Same pattern in Dutch collapse. Those who held British pounds and gold survived. The framework, 40 to 50% in traditional dollar assets for liquidity and ongoing expenses, 20-30% in hard assets, physical gold, silver, real estate in stable jurisdictions, 15-20% in assets denominated in likely next reserve currencies, Chinese yuan-denominated bonds, Singapore dollar holdings, Swiss francs, 10-15% in Bitcoin and digital assets as inflation hedge and jurisdiction-independent value store. Second, geographic diversification, not just assets, but access, establishing residency or citizenship in jurisdictions with currency stability. According to Henley's analysis, Tier 1 stability jurisdictions in 2026, Singapore, Switzerland, UAE, Portugal, New Zealand. These countries maintain low debt to GDP ratios, diversified reserve holdings, and strong rule of law. You don't need to move permanently. You need legal right to move if stage 4 accelerates. A second passport or residency permit is insurance. Third, strategic cash reserves. This seems counterintuitive when discussing dollar collapse, but in the early stages of crisis, cash becomes scarce. In the 1931 British crisis, those with liquid cash could buy assets at 40 or 60% discounts as desperate sellers needed immediate liquidity. Hold 6 to 12 months of expenses in cash, but be ready to deploy into hard assets when crisis hits. Fourth, debt positioning. In currency crisis, inflation typically spikes as currency devalues. Inflation destroys the real value of fixed-rate debt. If you have fixed-rate mortgages or loans in dollars, currency devaluation effectively reduces that debt burden. The British who had fixed-rate mortgages in pounds during the 1930s crisis saw real debt value drop by 40%. Don't pay off fixed-rate dollar debt early. Let inflation work for you. Fifth, income diversification. If 100% of your income is dollar-denominated from U.S. sources, you're fully exposed. Develop income streams in other currencies or jurisdictions. Remote work for international companies, businesses with international customer bases, investments that generate yields in multiple currencies. Sixth, knowledge, and skills. In every currency transition, the families who thrived weren't just those with repositioned assets. They were those who understood the pattern and could adapt quickly, study historical collapses, understand the mechanics, follow the corporate indicators, watch treasury auctions, monitor foreign reserve data. When you see the pattern accelerating, you'll know what's coming before 99% of people. Seventh, network and community. In crisis, information and connections become invaluable. Build relationships with people who understand these patterns. Join communities focused on macroeconomics, currency transitions, international diversification. The families who survived the guilder collapse, the pound collapse, they had networks that shared information early. This isn't about panic, this is about pattern recognition. The corporations see it, that's why $847 billion moved offshore. The central banks see it, that's why they're buying gold at rates not seen in 60 years. The wealthy see it, that's why 142,000 millionaires relocated in 2025. The question is whether you see it. 3 empires, 500 years, same 4-stage pattern. Same mathematical inevitability. Stage 1, reserve currency dominance and capital inflow. Stage 2, deficit spending and debt accumulation. Stage 3, smart money repositioning and quiet capital flight. Stage 4, trigger event, currency crisis, wealth transfer. We are in stage 3. The acceleration is measurable. Corporate offshore holdings up 76% in 6 years. Central bank gold purchases at 60-year highs. Millionaire migration at all-time records. Foreign treasury holdings declining for 22 consecutive months. Every indicator screaming the same message. The timeline from late stage 3 to stage 4 trigger, 18 to 36 months historically. We're 22 months into the acceleration phase. You have 2 choices: understand the pattern and position accordingly, or trust that 500 years of mathematical certainty will somehow break. But remember, this time is never different. The pattern is absolute. Mathematics don't care about military power, historical dominance, or American exceptionalism. They care about debt to GDP ratios, deficit spending, and capital flows. And right now, all 3 numbers are screaming that stage 4 is coming. The only question is which side of the wealth transfer you'll be on. Tell me in the comments, where do you think we are in this cycle? What are you seeing in corporate behavior, central bank actions, or your own observations that confirms or contradicts this pattern? I want to hear your perspective. And if this analysis opened your eyes, you need to see what's coming in the next video, because I'm going to reveal the 3 specific asset classes that outperformed everything else during the guilder collapse, the pound collapse, and every currency crisis in the last 200 years. Not theory, documented returns, exact positioning strategies that turned middle-class families into multi-generational wealth. You cannot miss this. The pattern doesn't wait. It doesn't need permission. It just unfolds. Thanks for watching.